Is he losing sleepless night? If he's not losing sleepless night, what is keeping him the confidence to buy into these stocks? Pankaj, when did you buy into these stocks, and why are you going against the trend?
Well, we've started nibbling into some of these names over the last, I would say, about couple of months or so. And it's still early days. We have not fully built out our portfolio. So we understand that these stocks have a hangover where some of these IPO investors might sell as their holdings get unlocked, and which is why we want to use this period over the next few months to buy into at least some of these companies where we are sanguine about their long-term growth prospects. Why? So, having seen, four bear markets over the last 25 years, I don't lose sleep over stock prices, Nikunj, anymore. Having said that, I firmly believe that probably internet will be the fastest growing sector in the Indian economy over the next decade. It's the most exciting place for any investor to be in over the next 10 years. And I think there's a huge amount of wealth creation that will happen in that space over the next 10 years, which effectively means no investor can afford not to invest into internet businesses. There are a lot of things which are working right for these companies, essentially, in terms of the kind of growth they've delivered or kind of scalable businesses they've built. And more importantly, the strong growth that they're going to deliver over the next 10 years. More importantly, they've reached many of these businesses, especially the ones which have got IPO'd, have reached critical mass in their business in terms of their size and scale. And I think after taking some feedback from public market investors, these businesses are making a very rapid pivot to profitability. And more importantly, many of these businesses are now evolving in an industry which is turning into an oligopoly nature of the industry, which effectively means in many of these businesses there are just two or three players. Take for example food tech, where you have two players between Zomato and Swiggy controlling over 90% of the industry market share. Experience tells us that when in any industry you have oligopoly kind of industry structure, the long-term profitability of that industry continues to remain very strong because it brings along with it pricing power. So slightly more medium term to long term, we remain extremely bullish in many of these internet businesses and India's internet sector as a whole. And we think this sell-off is a great opportunity for long-term investors to buy into some of these businesses because I must admit that a lot of these IPOs or most of these IPOs were mispriced at the IPO price last year, and there was a huge euphoria there. But I think all of that has now got settled down, and pricing is far more reasonable in context of the fundamentals of the business. And from a longer term investor's perspective, I find many of these businesses very attractive.
The most haloed one, the first one to go public, and if my memory serves me right, the first one to go public was Zomato, and then you had PayTm. Let's pick up these two names, household names, brands we associate with, companies which touch our daily life. There's never been a day in our life where we've not used the UPI service. There's never been a week in our lives where we've not used food delivery. Let's understand PayTm. What is the business model? The main business, which is transfer, they don't make money. Whatever they ventured in terms of making attempt to make profits, whether it is PayTm Mall or for that matter, they wanted to sell insurance or mutual funds, nothing's making money.
So, well, one caveat, we own both the businesses. I think that's not the case, Nikunj. The point is that the kind of rapid growth these businesses are delivering, the business underlying business economics are changing very quickly. And these are because they're technology-oriented businesses, the fixed costs remain stable over a longer period of time, and there's a huge amount of operating leverage that comes into play. Now, coming back to PayTm, just think about payments as an ecosystem. All of us understand that digital payments will keep growing in India. And you look at the space, we are just left with three players controlling over 95% of the industry. So it's an industry which is already in an oligopoly kind of industry structure. Talking about PayTm, the payments business was not making meaningful money last year when they got IPO'd, but in the last 4 quarters, there's a significant swing in the payments business. The contribution margin from payment business has gone from 80 crores absolute number in September last year to about 480 crores this year. So there's a very big swing that has happened in the payments business. And the fact is, with about mid-teens kind of a market share which they have in the payments business, the payments business itself is profitable. Point number one. Point number two, what also happens is in the digital world, what really matters or counts really in the early stage of evolution where India is your customer acquisition cost. And what we've seen through the funnel or through across broad spectrum of businesses that payments and e-commerce businesses are the ones which have the lowest customer acquisition cost, and which effectively means Paytm with 80 million transacting users, which are growing at high, 20% plus kind of a number, they tend to acquire customers at a relatively low cost, and then they can leverage that customers to cross-sell multiple products to their customers, which they are doing through their financial services and the clouds and commerce business, and which effectively means the customer acquisition cost for the other businesses tends to be very low, and those businesses then ride on the payments business to deliver very high contribution margins. So effectively, meaning our assessment is we've seen a very sharp swing in Paytm's operating numbers over the last 4 quarters from the time they've gone IPO. And while the management has guided for operating profit break-even by September of next year, we think they'll achieve that much before time, probably by March, by the fourth quarter of this financial year itself. And after that, because of the operating leverage coming into play, we think the operating leverage that's going to play out in case of Paytm and some of these other businesses will be very, very strong.
But Pankaj, while all of this is well and good, we were just discussing with our previous guest, aren't you just concerned that the valuations are out of whack?
Not really. As I said, I firmly believe that when these businesses were IPO'd, the IPO valuations were grossly mispriced. Having said that, all of us have seen that stock prices have corrected anywhere between 50 to 70 and in some cases 80% from the IPO prices. I think now where these businesses are, for someone like us who's a slightly more medium-term to long-term investors, where we think we are buying ownership rights in business with 5-year time horizon. In fact, in many of these businesses, we find valuations when we look through them from a 5-year prism, we look at valuations very compelling.
What about your outlook in terms of what the road ahead holds for a lot of these companies, given the steps that they have been taken? You spoke about a path to profitability and how some of these companies are actually seeing a turnaround. So do you think that over the next 6-8 months to 1 year, we are seeing this complete reset?
Oh yeah, absolutely, Avan. I think the good thing is most of these entrepreneurs or CEOs are taking very constructively the feedback from investors, and they're making very rapid pivot in their businesses. And given the size and scale that these businesses have achieved, that pivot is making a significant, huge difference or bringing out a significant delta to the operating numbers. We expect we own Zomato, and we think they should also achieve operating break-even or EBITDA break-even by fourth quarter of this year, while their food delivery businesses has actually turned EBITDA positive actually last quarter. Now, once these businesses achieve operating profit break-evens, from here on, when they deliver growth, then a significant part of their revenues, probably as high as 50, 60, 70%, will translate into, will flow into the EBITDA or operating profitability. And mind you that these businesses have, meaning our belief is that these businesses can grow at 25-30% for the next 5, 7, 10 years. And I must admit that after a very long while, maybe probably after the IT boom that I saw in the late 90s, I'm seeing businesses of certain size and scale giving growth visibility of 25-30% over the next 5-10 years. I haven't seen that in India in any of the industry over the last 20 years. So in that perspective, I feel very excited about these internet businesses and their growth trajectory over the next 10 years. Just to give you a very high level perspective, if you take India's entire e-commerce industry, it's about $100 billion. So it's about 3% of India's GDP currently as we speak. We are of the view that India's e-commerce industry can grow at 20% CAGR over the next 7-8 years, and it can become something like $700 billion. Just think about it, at $700 billion, even if I give them conservative revenue multiples to these businesses, the India's e-commerce business sector would trade anywhere between $4 to $5 trillion, and which is equivalent of India's current market cap, much higher than India's current market cap. So I think there's a huge amount of wealth that's to be created in these businesses over the next 10 years.
Okay, so you're clearly, taking a very long-term view as well, which is, of course, what you do, Pankaj, that we know. Now, you told Nikunj that there was recent times that a lot of these new age companies were available attractively. Then you just told Avan that you own Zomato. Did you buy the others as well? Incidentally, while we were just speaking, PayTm has hit a new 52-week low. It's looking like it's going to fall below 500. Would that be a great time? We even saw Nykaa before this bonus issue being available for less than 1,000 rupees a share.
Yes, the fact remains that some of these companies have this technical overhang of some of their pre-IPO investors wanting to take money out, or they've invested at valuations which are much lower and wanted to book profits. So, which is why there is a supply that's there in all of these names. But I think it's a matter of time as these companies deliver growth that it should get absorbed over the next few months or quarters. I don't know exactly how that plays out. But we also understand the fact these are non-fundamental factors. Some of these early investors selling out does not in any manner influence or change the value of the underlying business. As fundamental investors, we continue to remain focused on the value of the business. And if prices go lower because some of the investors wanting an exit irrespective of the price, that creates an opportunity for a long-term investor like us to buy into these businesses at more attractive prices and sit patiently on these businesses over the next 5-7 years, which is what we exactly do with our portfolio companies, and probably make healthy returns.
Pankaj, how much are you ready to allocate as part of your portfolio? I mean, the combined, let's say whether it's PayTm or Zomato or Nykaa or Policybazaar, that's a choice. But 10%, 15%, how much weightage should one attribute?
Currently, our holdings are about 5 to 7% in our portfolios across these businesses. But if prices correct or we get more attractive prices, probably I see it going to double digits and beyond that as well, because we are firm believers in the medium term to longer term growth potential of internet business in some of these companies in India. Mind you, also the other point I would like to make is, these businesses have reached some critical mass in their respective industries, and they've got IPO. Unlike go back to 20 years, and IT companies which got IPO at a very early stage in their life cycle, where the private equity markets were not so robust. These businesses, because they got funded fairly well in the private equity markets, they came to public markets at a relatively late stage of the business cycle, where the business model is by and large established. They've achieved critical mass in their business, because you look at, let's say, PayTm last year, they did a revenue of 5,000 crores. So they got IPO'd after they achieved 5,000 crores of revenue, which is very significant. A lot of these IT companies, or some of the larger IT companies as they exist in India, including the likes of Infosys, they got IPO'd at a relatively early stage of the life cycle. Much earlier, then they reached critical mass in their businesses. So I think in that sense, from a public market investors' perspective, the relative risk of failure of business is significantly lower in that sense.
All right, interesting to get in your take, Pankaj.